Hello, it's Jeffrey Christian of CPM Group. It's not quite 15 minutes after 11 o'clock in the morning of Tuesday, the 6th of August here in New York. Gold is trading around $2,433. Silver is about $26.75 or so. Silver did get over $27 earlier in the morning, but it's come back off. We've seen some very volatile markets. Gold reached a new record price, a high last week. It has come off sharply along with other assets on Monday. We saw a less than sterling U.S. employment and labor report released by the Bureau of Labor Statistics on Friday. And that has triggered this broad-based sell-off that we saw in stocks, bonds, all commodities. Yesterday, the market's a little bit unsettled right now. I'm going to talk about the long term and the short term, and I want to try to put what's going on in the economy and the stock markets, gold and silver, into perspective, both on a short-term basis and a long-term basis. So I'm probably going to talk about what's happening now on a shorter-term basis to begin with, and then hopefully I'll get into the longer term. CPM Group has just released its quarterly update of our 10-year projections from 2024 to 2033 for the global economy, national and regional economies, gold and silver, supply, demand, real and nominal prices. We update these at least quarterly, and we've done that. And in doing that, we have changed our economic outlook. I'll talk a little bit more about that later in the presentation. I want to focus now a little bit on employment because it was that BLS employment report that really triggered the sell-off. And I want to put both employment in perspective and the sell-off. Now, these are the two charts that appeared in the BLS report on Friday. And on the left-hand side, you can see unemployment rate. And you can see it starts with July 2022, and it's around 3.5%. And then it starts rising a little bit in the middle of 2023. And over the last 4 months, it's risen up to 4.3%. That's what triggered the sell-off starting in Monday morning in Asia and Japan, and then spreading around the world. Japanese stock market fell about 12%. U.S. stock markets fell much less. On the right-hand side, you have the non-farm payroll employment, a month-over-month change, which was 114,000. And you can see that's down from the 200 to 300 range that we've seen for most of the period from July 2022 to this year. Let's put that in perspective, though. This is the unemployment rate. It skyrocketed to a catastrophic 4.3%, which is, of course, in line with the economist's full definition of what full employment is in the United States. And you can see here that 4.3% is really lower than most of the period of time from 1970 until the present. So while unemployment is rising, it's rising from a historically low level, and there's plenty of scope to go forward. And that's very important when you consider fiscal policy and monetary policy and what's going on in the real economy, the supply and demand of goods and services. The reality is that while unemployment has risen, it's still very low. Now, is that trend going to continue? Quite probably. You can see there's a certain cyclicality to the unemployment rate. And we have been very strong in our employment and our unemployment conditions for a couple of years now. You know, the BLS looks at it for 2 years, and all of a sudden, wow, this is a terrible increase here. Put that terrible increase into perspective, and you still got a long way to go. And it's a similar pattern that you're seeing with interest rates and other factors. This is total non-farm employment. It's at record levels. More people have jobs in America than ever before. And you can see pretty much a steady progression. It accelerated for a while in the 80s and 90s. It came down. We had the Great Recession, and then we had the COVID lockdown, but it sprung right back. Let's put that 114,000 jobs increase into perspective. Again, going back there and looking at what the BLS shows people, oh my God, it's falling. It's falling sharply. It's the lowest level it's been since July 2022. Now let's go and look at it compared to the number of jobs created each month since 2020. It's actually a little bit higher than the average over that period. But you don't have to say, well, why'd you pick 2020? Let's go back to the beginning of the data in 1940. Yeah, the 114,000 jobs, new jobs, is in line with what we expect in a healthy economy, a non-inflationary, non-recessionary economy. So you got to put it in perspective, or you're going to be the person who buys straw hats in May and sells them in September, instead of being the person who, when everyone's yelling fire in the markets, you buy. Job openings, also very high. They're not at the record levels that we saw post-COVID, and this is just for professional and business services. Sorry, that's what the BLS made readily available. But you can see it's very high. And it's very high compared to where it was in the period between the Great Recession and the COVID lockdown. So the employment situation and unemployment rate, put into perspective, is not so bad. Similarly with the stock market. You've had these pundits and gurus on the internet, I won't name names, talking about how the stock market's going to crash. It's got to crash. There's going to be a 20, 40, 60, 80% decline in the S&P and the Dow Jones. S&P here is on the left, and it's larger because I tend to focus on it because it's 500 stocks instead of a few dozen stocks like the Dow Jones. The Dow Jones is on the right. The Dow Jones fell 2.6% yesterday. The S&P fell 3%. They both fell all the way. We haven't seen stock prices this low since May. 3 months ago. Yeah. Meanwhile, compared to where they've been back in 2022 when the BLS starts showing you that data, we have pretty healthy stock market. Now, was this the beginning of the big decline? It could be. If you go back to 1987, I'm that old. If you go back to 1987, you'll see that the stock market really coughed up about 15% of its value in September of 1987. And people remember the sharp decline on that one Monday, Black Monday, in October of 1987. But that was foretold by 6 weeks of steady declines in stock prices over the course of September and the first half of October 1987. And you tend to see that sometimes. Is this the beginning of that? It could be. We've seen several periods of time, for example, in 2022, but over the last 100 years, where you'll see 10, 15, 20% declines, and then the market dusts itself off. Given where we are, there's a lot of nervousness on the part of investors who are heavily invested in stocks because they're at record levels. And they're very nervous about it because if there is an economic downturn, that could come up. Now, these are the indices, and if you disaggregate it and you look at the stocks, the indices have been pushed higher with very sharp increases in a handful of stocks, the flavors of the month. But that's not unusual. That seems to be the way the stock market works. But again, putting yesterday's stock market crash, the meltdown that we saw, it was 3% off of record levels. Not exactly things to be afraid of. The dollar, meanwhile, didn't collapse. In fact, it was off a little bit yesterday against some currencies, but it continues to be relatively high. So what do we think is coming next? These are our 10-year projections for global real GDP. The dark blue line in the middle is global GDP. The light blue line is emerging and market economies. And the red line are the advanced economies or industrialized economies. We have a recession that we've been talking about for several years. That forecast line is a little bit off. Emerging in 2024, 2025. We've been saying that it could happen in the second half of 2024. Yeah, it could be, but it's probably more likely 2025 at this point. But there's a lot of uncertainties and dangers in the world politically, as well as economically, and in terms of the financial markets. Our expectation is that the recession, you can see here, it's pretty severe, especially if you compare it to the recessions in 1980, 82, 91, and 2001. It's more in line with the Great Recession, although it's not as severe as that, nor the COVID lockdown. But a significant recession, primarily in the industrialized economies. And then a recovery, and then slower and lower growth, both in the industrialized economies and in the emerging and developing economies over the remainder of our forecast period. So from 2026 to 2033. With the anti-globalization and deglobalization, the breakdown in international cooperation, the breakdown in international trade, and a variety of other factors, including heavy debt burdens around the world, our expectation is that growth will be limited compared to where it's been over the last 30 years, going forward in the post-recession recovery period. So that's what we're looking at for the economy. So what's it mean for gold and silver? As I said, we've just released our report, which has not only those economic projections and a discussion of what's behind them, but also projections for supply and demand and real and nominal prices for gold and for silver. And in the gold report, we talk about what central banks really are doing and what they're planning to do with gold over the next 10 years. What are central bank managers actually thinking about gold? It's radically different from what you hear in the market in terms of central banks' attitudes toward the dollar, which have been shifting in a more positive toward the dollar way over the last decade. And what central banks think about the dollar and gold and other currencies is radically different from the stuff you hear about the BRICS gold-backed currency and all that stuff. And, Bitcoins, yeah. So we talk about that. We have projections for what we think central banks will be doing based on our discussions with central banks and what they're saying. We have expectations of what the silver and gold investment demand will be under different economic scenarios. We have 3 scenarios that we put into these reports. Our main scenario, a high one and a low one. And then we have realistic projections from mine production, secondary recovery from scrap, which is becoming more important to gold and silver markets. Fabrication demand is a lot of over-enthusiasm about solar power, and above-ground refined inventories, which remains an issue that a lot of people don't seem to have a good handle. Coming back to the here and now, you can see the big decline on Monday in the gold prices. Our expectation is that the gold price dusts itself off. We've been saying that we thought it could trade between 2,300 and 2,500 over the next several weeks into September, but that we think in the last 3 or 4 months of this year, prices will probably move higher. And then on the right-hand side, you just have a longer-term chart from 2014 to the present to put the current record prices into a more historical perspective. Silver has shown greater weakness, greater downside potential, but it still seems to us to be relatively well supported around $26. We wouldn't be surprised to see $26 in the next week or two, and we think that that'll be tested. But we also wouldn't be surprised to see the price back over 30 over the next 6 weeks, and then higher over $32 for a brief period of time in the final quarter of this year and to next year. On Friday, I want to talk about central banks. Which central banks are not buying gold, that you've heard that they're buying gold, or that they want to buy gold, or they would buy gold if they had the money, and which are actually buying. CPM Group's monthly precious metals advisory will come out on Thursday. It has a very detailed discussion of which central banks are buying, which central banks are selling. Yes, central banks sell. And what the net flow of gold into central bank coffers has been year to date through June, I guess we have data, and on a monthly basis. So we'll see that on Friday. Again, we've just come out with our long-term projection updates for gold and silver, supply, demand, and price under 3 different scenarios over the next 10 years. Talks about what central banks are doing, investors, the relative weakness that we're seeing in investment demand for silver relative to investment demand for gold, realistic projections. Those reports range from $9,500 for a single report on a single metal to $26,000 a year for a subscription to quarterly reports on both gold and silver. If you're interested, contact CPM Group and we'll talk to you. And in between those two ranges, if you want a single report of gold and silver, it's more than $9,500, but it's less than $26,000. So if you're interested, info@cpmgroup.com, let us know, and we'll arrange for you to get these. Meantime, you can go to our website. You can get free reads, free videos, reports that we're doing for our clients that ask us to post them on our report. And you can always reach us at info@cpmgroup.com. That's all I have for now. Take care. Be good to yourself. Be good to others. Try to do something good for the world. And let's sit back and watch the parade.